flames were visible from miles away. A massive explosion. Israel's most critical refinery. Gone. But this wasn't just an attack on Israel. This was a message, a warning, to every single country that depends on oil. Because when refineries burn, prices don't just rise, they spiral. And the question nobody wants to answer is, who gets it next? Welcome, welcome, welcome to Currency Archives, where we break down the stories that actually affect your money, your future, and your world. Now listen, if you've been watching us for a while, you already know we don't waste your time. So do your old hands a favor today. Just move that finger slowly, find that subscribe button, and press it. You've earned that wisdom. Let us deliver it straight to you every single time. And before we dive deep into this story, drop a comment below. Where in the world are you watching us from today? We read every single one. Now, let's get into it. It was supposed to be an ordinary morning in Haifa. Workers arrived at their stations. Machinery hummed. Fuel moved through pipelines the way it had for decades. Israel's largest refinery, one of the most critical industrial facilities in the entire Middle East, was operating as normal. Then everything changed. Without warning, a swarm of drones appeared in the sky. They moved fast. They moved with precision. And within minutes, they found their target. The Haifa Refinery, a facility responsible for processing a significant portion of Israel's fuel supply, was hit hard. Massive explosions followed. Fires broke out across multiple sections of the complex. Thick, black smoke rose high into the sky, visible from miles away. Emergency teams scrambled to contain the damage. Sirens echoed across the city. Residents in nearby communities were told to stay indoors as toxic fumes spread through the air. By the time the fires were partially controlled, the damage was already done, and the world was watching. Iranian officials did not immediately claim full responsibility, but the strike bore all the hallmarks of a calculated state-level operation. The drones used were sophisticated. The target was not random. Haifa's refinery is not just an industrial site. It is a strategic asset. It supplies refined fuel to military operations, commercial transport, and civilian infrastructure across Israel. Hitting it was not an act of random aggression. It was a deliberate economic message. And that message was received loud and clear. To understand why this strike matters so deeply, one must look at what happened in the days before it. U.S. and Israeli forces had reportedly carried out a series of strikes on Iranian facilities, targeting energy depots and infrastructure tied to Iran's military supply chain. These were not small operations. They were designed to weaken Iran's economic backbone and reduce its ability to fund and sustain its military activities across the region. Iran watched. Iran calculated. And then Iran responded. But instead of targeting a military base, instead of hitting soldiers or weapons storage, Iran chose something far more dangerous. They chose to strike at the economy. They chose to send a message that said, if you hit our energy, we will hit yours. This was a shift that analysts had feared for months, and now it had arrived. The choice of the Haifa refinery was not accidental. Strategic planners understand that modern warfare is no longer fought only on battlefields. It is fought in boardrooms, in energy markets, and in the calculations of investors and business leaders who move capital based on risk. By targeting a refinery, a civilian and commercial facility, Iran demonstrated that it was willing to raise the stakes far beyond conventional military exchange. It was a signal, a very expensive, very dangerous signal. Markets responded almost immediately. Oil prices jumped within hours of the news breaking. Shipping companies operating in the region began reassessing their routes. Insurance premiums for vessels passing through nearby waters started climbing. Fuel suppliers across Europe and Asia quietly began reviewing their contingency plans. For the average person watching the news, this looked like a story about fire and smoke in a distant country. But for business leaders, economists, and strategic analysts, this was something far more serious. This was the opening move in what could become a prolonged and deeply damaging assault on global energy infrastructure. The Haifa strike did not just damage steel and pipelines, it damaged confidence. It damaged the assumption, held by markets and governments alike, that critical energy infrastructure would remain off limits even in the most intense conflicts. That assumption is now gone. And once that line is crossed, it is very difficult to uncross it. Both sides now know that energy infrastructure is a legitimate target. Both sides now understand that the other is willing to go there. And both sides, along with the rest of the world, are now waiting to see what happens next. The fire at Haifa was not the end of something. It was the beginning. There's an old saying among economists and military strategists alike. The most powerful weapon in the modern world is not a missile. It is a pipeline. For decades, this idea remained largely theoretical. Nations understood it. They studied it. They wargamed it in classified briefings and academic papers. But very few believed they would actually see it play out in real time. At this scale, at this speed, with these consequences, they were wrong. What happened at Haifa was not simply an act of retaliation. It was the opening declaration of something the global economy has not seen in over 50 years. A deliberate, calculated, strategic assault on energy infrastructure as a primary weapon of conflict, not a side effect of war, not collateral damage, the actual weapon itself. To understand how dangerous this moment truly is, one must go back to 1973. That year, Arab oil-producing nations imposed an embargo on countries that had supported Israel during the Yom Kippur War. They did not fire a single missile at New York or London. They did not send soldiers into European cities. They simply turned off the oil. And within months, the United States was in economic chaos. Fuel lines stretched around city blocks. Inflation surged. Businesses collapsed. Entire industries were brought to their knees, not by bombs, but by the absence of energy. That embargo lasted less than a year, and it nearly broke the Western economy. What is unfolding today has the potential to be far worse, because this time it is not an embargo. It is direct physical destruction. Refineries are not being switched off. They are being blown apart. Iran's decision to strike Haifa was rooted in a very specific strategic calculation. Iranian planners understood something that is easy to overlook in the noise of daily conflict updates. They understood that Israel, for all its military strength, has a significant energy vulnerability. The country has limited domestic oil production. It relies heavily on imported crude and its own refining capacity to meet civilian and military fuel demands. Remove that refining capacity, even partially, and the pressure on Israel's economy becomes immediate, visible, and deeply uncomfortable. But Iran's calculation went even further than Israel. By striking a major refinery in a highly connected region, Iran was sending a message to every country watching, to every investor monitoring the situation, to every energy company with assets in the Middle East. The message was simple and devastating in its clarity. Nowhere is safe. Nothing is off limits. This changes everything about how businesses and governments must now think about energy security. For years, corporations built their supply chain strategies around the assumption of stable, predictable energy access. They signed long-term contracts. They built infrastructure. They made billion-dollar investment decisions based on the belief that even in times of conflict, energy facilities would be protected, if not by law, then by mutual self-interest. That belief has now been shattered. The United States finds itself in a deeply uncomfortable position. American forces have been directly involved in strikes on Iranian energy and military infrastructure. That involvement made the U.S. a participant in this conflict, not merely an observer. And Iran has taken note. American energy assets in the broader region, American allies dependent on Middle Eastern oil, and American companies with exposure to global fuel markets are all now recalibrating their risk models. What was once considered a regional conflict is rapidly developing the characteristics of a global economic event. Analysts who study energy warfare describe what is happening now as an infrastructure feedback loop. One side strikes an energy asset, the other retaliates against an energy asset. Each strike raises the cost of the conflict for both sides, but also for every country connected to those energy systems. And in today's world, almost every country is connected. The loop, once started, is extraordinarily difficult to stop, because every retaliation justifies the next. Every destroyed refinery creates economic pressure that demands a response. And every response pushes the world one step closer to a crisis that no diplomatic conversation seems equipped to handle. The energy war nobody wanted has arrived, and the world is only beginning to understand what that means. There's a moment in every major crisis when the financial world stops speculating and starts bleeding. That moment has arrived. Most people watch a conflict unfold on their screens and see fire, smoke, and political tension. But experienced market analysts, portfolio managers, and senior economists see something entirely different. They see numbers moving. They see supply chains fracturing. They see the invisible threads that connect a burning refinery in Haifa to a fuel pump in London, a shipping port in Singapore, and a manufacturing plant in Detroit. And right now, every single one of those threads is under enormous pressure. The first and most immediate consequence of the Haifa strike landed exactly where analysts expected: oil prices. Within hours of the news breaking, crude oil futures jumped sharply. Traders who had already been monitoring the escalating tensions in the region moved quickly. Positions were adjusted. Hedges were placed. And the price of oil, the single most important commodity in the global economy, began climbing in a way that made serious investors deeply uncomfortable. This was not panic, this was calculation. Professional traders understand something that casual observers often miss. Oil prices do not just respond to current supply disruptions, they respond to perceived future risk. And the moment a major refinery is destroyed in a conflict zone, the market begins pricing in the possibility of more strikes, more disruptions, more uncertainty. The actual damage at Haifa was significant, but the fear of what comes next is what truly moves markets. And fear, once it enters an oil market, is extraordinarily difficult to remove. Beyond oil prices, the shipping industry is facing its own quiet crisis. The waters surrounding the Middle East are among the most strategically important shipping lanes on the planet. Enormous volumes of refined fuel, crude oil, liquefied natural gas, and commercial cargo pass through these routes every single day. Insurance companies that cover vessels operating in these waters had already raised their premiums significantly in recent months as tensions escalated. After the Haifa strike, those premiums jumped again. Shipping companies began making difficult decisions. Some rerouted vessels away from the region entirely, adding days and significant cost to journeys that would normally pass directly through. Others reduced the size of their shipments to limit exposure. A small number temporarily suspended operations in certain corridors altogether. Each of these decisions, made quietly in boardrooms far from the conflict zone, adds cost. That cost moves through supply chains. It reaches manufacturers who depend on imported materials. It reaches retailers who depend on reliable logistics. And eventually, it reaches the consumer in the form of higher prices for goods they buy every single day. The industries most exposed to this crisis extend far beyond energy companies. Airlines are watching with serious concern. Jet fuel prices are directly tied to oil markets and refining capacity. Any sustained disruption to refined fuel supplies pushes operating costs higher for every airline on the planet. Those costs translate directly into higher ticket prices and reduced profitability. An industry that only recently recovered from the financial devastation of the pandemic, years, now finds itself staring at another serious threat. Chemical manufacturers face a similar problem. Petroleum is not just a fuel. It is a raw material for thousands of industrial products. Plastics, fertilizers, pharmaceuticals, synthetic fabrics. When refining capacity is destroyed and oil prices rise, the input costs for these industries climb sharply. Margins compress. Investment decisions are delayed. Hiring slows. Agricultural supply chains are also feeling the pressure. Modern farming is deeply dependent on fuel, for machinery, for transportation, for the production of fertilizers derived from petrochemical processes. Rising energy costs in a conflict-driven market do not stay contained to the energy sector. They spread. They infect every connected industry. Smart businesses are already moving. Large multinational corporations with experience navigating geopolitical risk have activated their contingency protocols. Energy procurement teams are locking in forward contracts to secure fuel supplies at current prices before further escalation pushes costs higher. Logistics managers are mapping alternative supply routes. Treasury departments are hedging currency exposure in markets most vulnerable to oil price volatility. These are not panic moves. They are professional responses to a rapidly changing risk environment. But not every business has these capabilities. Small and medium enterprises, the backbone of most economies, do not have dedicated geopolitical risk teams. They do not have the financial firepower to hedge against oil price spikes. They absorb the cost increases directly, and when those increases become severe enough, some of them do not survive. The bleed has already begun. It started in oil futures. It moved into shipping premiums. It is now working its way through supply chains, input costs, and business confidence indices across the global economy. Most people will not feel it immediately, but they will feel it. Rising prices at the fuel pump, higher costs for goods, tighter margins for businesses, slower economic growth in regions already under financial pressure. This is how energy wars are truly fought, not just in the skies above Haifa, but in the quiet, invisible machinery of global commerce, and where every disruption compounds the last, and where the real casualties are measured not in lives lost, but in livelihoods destroyed. The markets are bleeding, and the wound is far from closed. History has a pattern that most people only recognize when it is too late. Every major global economic crisis, every collapse that reshaped industries, destroyed wealth, and altered the daily lives of ordinary people across the world, began with a moment that felt manageable. A moment where leaders on all sides believed the situation was still under control. A moment where the assumption was that reason would eventually prevail, that cooler heads would step forward, and that the worst-case scenario was simply too extreme to actually materialize. That assumption has been wrong before. It may be wrong again. To understand what happens if this conflict does not stop, if the strikes continue, if refineries keep burning, if diplomatic efforts continue to fail, one must be willing to look directly at the worst-case scenario without flinching. The 1973 oil embargo offers the closest historical parallel. But even that comparison understates the danger of the current situation. In 1973, the weapon was restriction. Nations chose to withhold supply. Infrastructure remained intact. When the embargo ended, production resumed relatively quickly. Recovery, while painful, was possible within a defined time frame. What is happening today is fundamentally different. Infrastructure is not being restricted. It is being physically destroyed. Refineries take years to rebuild. Supply chains that are severed do not reconnect overnight. And the psychological damage to investor confidence, the quiet but devastating erosion of trust in the stability of energy markets, does not heal simply because a ceasefire is eventually announced. The damage being done right now has a permanence that the 1973 crisis did not. If the strikes continue at their current trajectory, energy analysts project a series of cascading consequences that would unfold in distinct and increasingly severe stages. In the first stage, already partially underway, oil prices would continue their upward climb, not gradually, in sharp, volatile movements driven by each new development in the conflict. Markets would become increasingly difficult to predict. Investment in energy-dependent industries would slow sharply as corporations delayed major decisions until clarity emerged. In the second stage, the pressure would shift from markets to governments. Nations heavily dependent on Middle Eastern energy across Europe, Asia, and Africa would begin making emergency decisions. Strategic reserves would be tapped. Emergency supply agreements would be negotiated at premium prices. Governments that had built their fiscal plans around stable energy costs would face sudden and serious budgetary pressure. In the third and most dangerous stage, the economic pain would become political. Populations facing rising fuel costs, higher food prices, and slowing economic activity would demand action from their governments. That political pressure would push leaders toward harder positions, reducing the already limited space for diplomatic compromise. The conflict, which began as a regional military exchange, would increasingly shape the domestic politics of countries thousands of miles away. This is how regional conflicts become global crises, not through a single dramatic moment, through a slow, grinding accumulation of economic pressure that eventually becomes politically unsustainable. The window for diplomatic resolution is narrowing faster than most official statements acknowledge. Behind closed doors, senior diplomats and economic advisors in multiple capitals are already running scenarios. They understand that every additional strike on energy infrastructure makes a negotiated settlement more difficult, not less. Each destroyed facility becomes a grievance. Each market disruption creates a domestic political cost that makes compromise harder to sell to an angry population. The international community is watching, but watching is not the same as acting. And in the gap between observation and intervention, the situation continues to deteriorate. For businesses and investors paying close attention, the strategic calculus is becoming increasingly clear. The smart money is not waiting for a resolution before adjusting. It is moving now, diversifying energy exposure, reducing dependence on single-source supply chains, building financial buffers against sustained volatility, accelerating investment in alternative energy infrastructure that reduces vulnerability to geopolitical disruption. These are not pessimistic moves. They are rational ones, made by people who understand that hope is not a strategy, and that the businesses which survive moments like this are the ones that prepared before the crisis fully arrived, not after. The Haifa refinery fire will eventually be extinguished. The smoke will clear. The immediate images of destruction will fade from the news cycle. But the consequences will not fade with them. The world has crossed a threshold. Energy infrastructure, the invisible foundation upon which modern civilization is built, has been established as a legitimate and viable weapon of conflict. That knowledge does not disappear when this particular conflict ends. It carries forward. It reshapes how future conflicts are planned and executed. It permanently alters the risk calculations of every nation, every corporation, and every investor with exposure to global energy markets. The question is no longer whether the world will pay a price for what happened at Haifa. The question is simply, how high will that price go?